Good evening. Welcome to STCIRA's educational webinar entitled Self-Directed Retirement Accounts and Real Estate Investing. I'm Jackie Knight, Corporate Training Director for STC, and I'm happy to have you join me this evening. We are going to go right ahead and get started, and I do want to begin with a bit of information about STC. We are a retirement plan administrator, so we do not provide legal, tax, or investment advice. We also don't sell or represent any securities or any investments of any kind. We are not a registered investment advisor, and we do not represent or endorse any particular investment opportunities. And I will be talking about some different investments in this presentation, and particularly real estate investments. We do recommend that you consult with your legal, tax, and investment advisors prior to making any investments. In this evening's webinar, I am going to begin with a bit of general information about self-directed retirement accounts, the benefits of self-directing, the guidelines that must be followed with all retirement account investing. I'm going to give you a little bit of information about what exactly STC does for our clients, and then we're going to talk about choosing and funding an investment and purchasing real estate in particular. And at the end, I will open the floor for your questions. So to begin with, I do want to define what is meant by the term self-directed retirement account. Some people do have a misunderstanding of what this means. With a truly self-directed retirement account, you, the retirement account owner, can choose any type of asset that is permitted by law, not simply what the custodian or the administrator or the facilitator may permit you to do, but anything that is actually permitted by the IRS or the ERISA rules, depending on which entity governs the type of plan you have. So that means that you could include what many consider non-traditional assets, things like real estate or mortgages or tax liens. Excuse me. Self-direction also means that you manage your retirement account investments. So you make the decisions related to those investments. If you decide you want to purchase a piece of real estate in your retirement account and you want to rent it, you will be the one that will decide the rental rate. You will decide if you want to make improvements to that property, if you want to buy a new stove, refrigerator, paint the building, and if at some point you decide you want to sell, you will decide the selling price. So you manage your retirement account investments in a self-directed account, meaning you have control. Now, the self-directed industry has grown significantly over the last 15 years. We are seeing a large portion of the investments in real estate. So many folks are using retirement funds to diversify into real estate. A self-directed retirement account is not a type of plan. It means that you hold the plan with a company that permits self-direction. Retirement plans are laid out by the IRS and ERISA. Traditional IRA, Roth IRA, individual retirement account or arrangement. You've probably heard of these plans. You can make contributions from your earned income into this type of plan. They do have maximum contribution allowances. And for 2017, to both of these accounts, you can contribute a maximum of $5,500 of earned income. If you are 50 years or older, you can increase that by $1,000 and go up to $6,500 of your earned income. The difference between these two plans is that in a traditional IRA, like the majority of plans, your contributions are pre-tax. In other words, you don't pay taxes on the money that you put into the account in that year. Rather, when you begin taking distributions after reaching retirement age, qualified distributions, then those distributions are included in your taxable income in the year that you take them. A Roth IRA is different. You do pay taxes on the contributions that you put into a Roth IRA account. However, when you begin taking qualified distributions, those distributions are not taxed. So the monies that you put into the Roth account as they earn and grow, those earnings on those monies are not simply tax deferred, they are actually tax tax-free as long as they are part of a qualified distribution. So Roth accounts can be very desirable for that reason. A SEP account is a simplified employee pension plan. Often small business owners will have this type of plan for their employees and themselves. A sole proprietor can also have a SEP plan. These plans allow for higher contributions from the earnings of the business that they are on. For 2017, the maximum SEP contribution is $54,000. So you can see it's significantly higher than a traditional or Roth account. A simple plan is a savings incentive match plan, also sometimes used by sole proprietors or maybe partnerships, sometimes small business owners. For 2017, the maximum simple IRA contribution is $12,500. And if you're 50 years or older, you can add $3,000 to that, so it's $15,500. Now, I brought out onto your slide 4 different plans that all say former employer. A 401k is a regular for-profit company's plan. 403b, often nonprofits or charitable organizations will have 403b plans. A TSA is a tax-sheltered annuity. A TSP is a thrift savings plan. If you formerly worked for an employer, don't work there anymore, and still have monies in their plan, you can move that money out of that plan to a new custodian administrator, and then you can self-direct if you wish. So that's if you're a former employee, excuse me. If you currently are employed and are participating in, say, a 401k, you will need to go to your plan administrator and talk with them and ask them if they're if you are allowed to move any funds, roll any monies out of that account to a self-directed account. Some plans do permit that if you have reached a certain age, or perhaps if you brought money into that plan from a previous employer, you may be able to move those monies out. Again, you'll need to check with the administrator of your plan to determine if you can do that. If you would like to open a traditional Roth, SEP, or simple plan, you do want to do that, a new plan to make contributions for 2017. You do want to make sure that the plan is open by December 31st of this year so that you can make a contribution for this calendar year. I want to talk briefly about the benefits of self-directing your retirement account as opposed to simply having it with a brokerage firm, say, that might permit you to invest in stocks and bonds and mutual funds. Probably maybe the most significant difference is that you can truly diversify your retirement holdings into a wide variety of different types of assets, including real estate, mortgages and notes. So mortgages would be loans that are secured by property. You can make personal loans, promissory notes from your retirement account. You can also invest in things like private businesses. So you can really diversify into different asset classes. And most financial planners believe that, diversification is a key to secure and stable financial investing. With self-direction, as I mentioned earlier, you choose the investments and you control the investments in the transaction. In addition, you can increase your buying power, the buying power of the money that you have in your account, by using leverage in a real estate transaction. And I will talk a little bit more about that on the next slide. Because of all of those things, but being able to diversify into a variety of assets, the control that you have in making decisions relating to the investments that you have, the possibility of using leverage, because of all those things, you may be able to experience a significantly higher return on your retirement monies than you perhaps could in a more limited type of account. I do want to talk about using leverage in your retirement account because many folks interested in real estate investing might consider this. Again, you can increase your buying power by getting a loan. It's actually your retirement account that's getting the loan. It must be a non-recourse loan. I'm going to tell you exactly what that is on the next slide. But first, I want to give you an example. We had a client who wanted to purchase a property to rehab it and then sell it. The purchase price was $250,000. She had $125,000 cash from her IRA that she used, and then she financed $125,000 of the purchase price. So it was a 50% valued loan. She then took another $50,000 from her retirement account and paid a contractor to renovate the property. That renovation was complete and the property sold in a 9-month time period, and she netted $100,000 on that investment. She had a 57% return over that 9-month period, or a 76% annualized return. So it can behoove you, if you feel that an investment is a good investment, but you don't have sufficient funds to fully fund it, it may behoove you to look into a non-recourse loan in order to be able to do that transaction. Now, a little bit more about non-recourse loans. What exactly is it? A non-recourse loan simply means that the security instruments, the notes and the mortgages, allow no recourse against the individual account holder or the balance in your retirement account. If there's a default or foreclosure, the property that the loan is on is the only source of repayment. So there's no other recourse. Now, a non-recourse loan has no income or employment verification requirement. In this case, it's an IRA, LLC, with our company that's getting this loan. Your IRA does not have a job. There's no regular income coming into this vehicle. So there's no income and employment verification. And I'm going to just go through some general industry standards. You would need to talk to individual lenders and see what their particular requirements are. These will be just some general guidelines that could be a little different depending on what lender you go to. Required documentation, usually, well, it's always going to require a loan application, a purchase and sale contract. They will want to see a statement from your IRA or whatever type of account you have, if it's a SEP or a simple. They'll want to see your IRA statement. They will want an appraisal of the property, and if it's a rental, they will want to see a rent roll. Loan guidelines. The maximum loan to value is generally 70%, which means you will need to be able to put down 30% on that property. Maximum term, anywhere from 20 to 30 years. And there are companies that do adjustable rate mortgages. And I've seen 3-1, 5-1, and 7-1 ARMs. They will also be looking for an income to expense ratio of about 1.25. And most companies will require some amount of reserve cash kept in your retirement account, anywhere from 3 to 6 months of the property's expenses. Let me just mention why that is, because if your retirement account owns this property and you have a plumbing problem or you have a roof problem, you need to repair the roof or put a new roof on, you cannot personally pay to have that done. Your retirement account must pay for that as the owner. So that's why most lenders will require a reserve funds of some amount, depending on the property and the loan amount, in your retirement account. They'll have to be held there in reserve in case of those possibilities. Eligible properties for non-recourse loans, single-family residences, some condos. Again, you'd have to check with a particular lender. 2 to 4-plex units, multifamily units, so 5 or more units, and retail, office, and warehouse space. All of those are eligible properties. Now, some things are ineligible for non-recourse loans. Mobile homes. You would not be able to get a loan for a mobile home from a bank lender for your retirement account. Timeshares, condo hotels are not eligible. Some restaurants, residences that have 5 or more acres, and farms are generally ineligible properties. So something to think about when you're looking at the possibility of a real estate investment, and can you wholly fund it, or do you need to have other funding sources? A non-recourse loan is a possibility. Let's talk a little bit about the guidelines that must be followed with every retirement account, guidelines that must be fulfilled. There are administrative requirements for all retirement accounts, self-directed and others. An annual valuation of your account must be done, and an annual report sent to the IRS. It's a Form 5498. Books, detailed records of all of the transactions, revenues, expenses, all of those things must be maintained in detail. Depending on what you own and where you own it, some state filings may be required, and in some cases, tax returns may be required. And I will mention here that if you do use a non-recourse loan, a potential tax can come into play. Its acronym is UDFI, and that stands for Unrelated Debt Financed Income. And basically, you would be debt financing a property that was bringing income into your retirement account. So if you do use a non-recourse loan, there is the possibility of triggering UDFI. And that is a little complex topic. I don't have time for that in this webinar. I have covered it in previous webinars, and we do have recordings on our website, so you can go listen to those. That's generally the case when a tax return is required. There are some operating business investments that could also trigger a tax liability. Pretty rare, but they are possibilities. STC is a full service administrator. So we do all of these, fulfill all of these requirements for our clients' accounts. With one exception, we cannot do the tax return because we are not an accounting firm, but we can give you and your tax preparer all of the information that you need if that does come into play. So you would be able to take care of any tax return that might be required. So those are some guidelines. Some additional guidelines are that there are actually assets that you may not invest in. There are prohibited assets. One of those is life insurance contracts. Another are collectibles, things like rugs, beautiful Persian rugs, works of art, stamps, coin collections. Those are not permitted as assets held in a retirement account. In addition, there are some transactions that are prohibited, and you do want to keep in mind that when you engage in a transaction for your retirement account, it is to be for the benefit of the retirement account, not in order to be able to benefit someone else. So the transactions do need to be for the purpose of benefiting your retirement account. You cannot borrow money from your retirement account. That is prohibited. You also cannot pledge your retirement account assets to secure a personal loan. That is not permitted. And you cannot utilize your personal credit or personal guarantee to obtain a loan for your retirement account. So that's why that non-recourse loan is the only type of loan that is permitted when there is an IRA involved in a transaction. So you'll want to keep that in mind. You also cannot benefit any disqualified person with a transaction that your retirement account engages in. So let's take just a moment and look at who disqualified persons are. And you'll see that you are the first person I put on the list. So you and your retirement account are separate entities, and you cannot do a direct transaction with your retirement account. So let me give you an example. Let's say that you own a vacation rental property in Hilton Head. Your retirement account cannot purchase it from you. That is a prohibited transaction because it involves a disqualified person, you. And if you are married, that would include your spouse as well. If your spouse owned that property, your retirement account could not purchase it from your spouse. There are other family members who are also disqualified. Your ascendants, so that would be your parents, your great-grandparents, your grandparents, anybody up the line are disqualified persons, and your descendants, so that would be your children, your grandchildren, your great-grandchildren, they are all disqualified. However, lateral family members are not disqualified persons. So that would include brothers and sisters, aunts and uncles, nieces and nephews. Your retirement account can do a transaction with them. So if your brother owned that property at Hilton Head, your retirement account could purchase it from your brother, but not if your mother owned it or if your son owned it. So you just need to be kind of aware of these things when you're thinking about transactions you might want to do. There are also two entities who are disqualified persons to your retirement account. Any company if you are a majority shareholder, and any company if you are an officer, a director, or a highly compensated employee. So you want to keep that in mind. Now, STC, I want to give you just an idea of the services that we offer our clients. We set up a retirement account LLC structure for each client account, and I will explain why we do that and how that benefits you. We have CPAs and attorneys to answer your technical questions. We offer unlimited guidance on transaction compliance. So we will review your transaction, talk with you about the parties, how you're structuring the transaction to make sure that it complies with the IRS rules. We handle all that back office support, that administrative, the annual valuation, the report to the IRS. We handle all of that for you. We maintain financial statements for your LLC that is owned by your retirement account. So you will get regular financial statements. You'll be able to access your information online. We do the supervise the regulatory reporting, and we oversee the annual valuation. So we really try to take care of all of that administrative function and then offer you guidance on structuring and transaction compliance, so that you don't have to be the expert in all of those things. You can simply focus on finding the best investment for your retirement portfolio. Now, I do want to talk a little bit more about this LLC structure because it is one of the key features that sets FTC apart from many other companies. We set up an LLC for each client account, and we do this because it offers you maximum flexibility in structuring your transactions. It makes it straightforward to partner with other parties. I'll talk a little bit more about that on the next slide. When you go to get a loan, it's actually the LLC that the loan will be that's whose name it will be in. When you purchase a property, it will be in the LLC's name. So it gives you a lot of flexibility in structuring transactions when you have this LLC. And it is a very, it's not a generic business LLC. It is a very specialized LLC. It is designed to be owned by a retirement account. So the language used in the organizing documents, the operating agreement, the articles of incorporation, all meet the requirements for the rules related to retirement accounts. It's a very specialized LLC that we do. It does also provide an additional layer of asset protection because it is a limited liability company. It also gives you checkbook control over your retirement account fund so that you have a very quick response to investment opportunities. We know that those can come and go very quickly. But I do want to say that we do not give our clients the checkbook for their retirement account. You'll see I have checkbook control in quotes. And we do that really as a protection for you. If you were to unknowingly engage in a prohibited transaction, there are penalties for that. The penalties can be severe, up to even forfeiting your retirement account. So rather than put you in that kind of a precarious position, what we do is we review your transaction, and we do that immediately. You can fax or email the documents to our client services department. They will immediately review the transaction. If they have all of the documents and the supporting backup, by 2 p.m. Eastern Time, they can same day fund that transaction. So you can get same day funding, but you still have our experts looking over your transaction, making sure that all the I's are dotted and the T's are crossed. If we don't have those documents by 2 p.m., we can fund the transaction the next business day. So it's protected checkbook control that our LLC offers you. It does, using this structure does simplify asset titling. As I mentioned earlier, if you go to purchase a piece of real estate, it will be titled in your LLC's name. And this structure does make it simple to pool or partner with other funding sources. Your retirement account does not have to wholly own an asset. It can be a co-owner. Now I want to show you our account structure setup. You'll see here in this schematic, you'll see on the upper left your current custodian, and you fill out documents that you would direct your monies to our self-directed custodian. We would set up the LLC in the state of your choice. Once the monies have moved to our custodian and the LLC is set up, the monies would move to a bank account that your retirement account LLC has access to. And then you're ready to begin funding these investments. Here you've got 3 wholly owned investments in your retirement account. Now I want to begin talking about different investments and then focusing on real estate investment. You have so many options with a self-directed retirement account. Single or multifamily homes, vacation property, raw land, building lots, commercial buildings, real estate syndications, and tax liens. Those are all different types of real estate investments. You can also invest in private business investments or operating businesses or precious metals. There are guidelines on precious metals, but there are a variety of things that you can invest in. And you can invest in the Forex market, foreign currency, options, futures, and of course, you could always have a piece of your self-directed account in a brokerage account, stocks, bonds, mutual funds. So you really can diversify very widely. Now let's talk about how you would do an investing transactions with SEC. You can request, it's not required, you'll see I say it's optional, request a review of your transaction and your structure of that transaction in advance. We encourage you to do that, to call us, to talk with us, to submit your documents to let us see how they're written, to make sure that they comply with the rules. You can do that as much as you need to. We are happy to look over your documents and talk with you about them. Then you would complete a form. It's called a request transfer of funds. And you would complete that form and any backup documents required. You would email or fax those to our client services department, and we review those forms, those documents. If we have any questions about them, we call you and we talk through anything and make sure that everything is clear, everything is correct, and how the documents are titled, etc. And then we process that transfer request, and the funds are sent from your LLC bank account to the seller. And once the seller receives them, then your retirement account owns that asset. So you do have that immediate funding of your transaction. Now let's look specifically at purchasing real estate. Now, we cannot offer you any properties for sale or assist you with purchasing, finding a property, or determining what kind of an offer you want to make. That is entirely up to you. This is self-direction. You are directing this. So you will find the property. We can't give any recommendation about whether or not it's a good investment. We can't give any rental advice or any resale guidance. We're not permitted to do that. But so you would locate the property and make an offer. Now this offer must be in the name of the buyer, which is your IRA LLC. Now, let me just say that if there is more than one buyer, let me let you know that you could co-invest with your retirement account. Let's say you have monies personally to invest and your retirement account has money to invest. Those two parties together can, at the inception of a transaction, purchase a property. Then that offer must be in the names of both of you personally and your IRA LLC. If it's just your IRA LLC, then that's the name on the purchase offer. Now, generally, we find that clients need an escrow deposit. And what we will need in that case is a copy of the contract that shows your IRA LLC as the buyer and that request to transfer funds form. Once we have those, then we can create a deposit check for you. We do ask for at least one business day prior to your closing on the property that you send us the HUD or the settlement statement that again shows the IRA LLC as the buyer and another request to transfer funds form for the purchase price, the remaining purchase price. The latest we could get that would be 2 p.m. of the same, of the day, and then we can get the check ready that day. So really at least one business day, but we really like more time if that's possible for you. It is best to provide additional time in case there is any issue. We cannot wire funds out if the buyer's name is listed incorrectly or improperly, or if we have any questions. Say that there was a down payment made, but we know that that didn't come from the IRA account. If, for example, you personally put the IRA or put down the down payment, but your IRA is buying the property, we cannot do that. That would be a mixing of monies, and that we can't fund that transaction. So we do need to want to see the documents in advance. If there's anything that raises a question, we want to be able to talk to you about it before closing. So please feel free to call our client services department, in advance and discuss your transaction with them. Now then, what would happen is once we've got those documents, typically the disbursement of the funds do need to be guaranteed funds. That's what most closings will require. So our clients usually ask us to issue a wire, or it could be a bank official check, either of those, and then we can expedite that mailing if necessary, expedite that delivery fee. You, the client, go to the closing and sign the closing documents. This is one of the benefits of using the structure that we have, the IRA LLC, is that you go to the settlement table and you sign all the closing documents. With some other companies, you do have to send the closing documents into them and they have to sign them. So then you might have a delayed turnaround depending on if they sit on somebody's desk or how long it takes them to get processed there. With STC, you can actually go to the closing yourself. We don't need to approve or sign the documents. What we do ask is that you send a copy of the closing documents to us, and we keep them in your files for your account, and you can keep the originals. As I mentioned earlier, you do have the option to use borrowed funds. Again, it must be a non-recourse loan, and it may trigger UBIT, unrelated business income tax, in the form of UDFI, unrelated debt financed income. So you do want to keep that in mind. If the IRA LLC is the borrower, then of course the IRA LLC must make the loan payment. Now I'm going to tell you on the next slide that you can actually partner with another entity, and I mentioned earlier with yourself, your personal investing money, and your retirement account. If either of those two parties have a loan for their portion, it still must be a non-recourse loan. And if the loan is for the personal portion, then the payments on that loan must be made personally. So I'll explain that a little bit more right now. You can partner with anyone. Your retirement account can partner with anyone at the inception of a transaction. So that includes your personal money or your spouse's retirement account or your father or your daughter. Normally, they are disqualified persons. But if you partner at the inception of the transaction, that is permissible. Now, if you do that, if you partner with someone and any of those persons are disqualified, then the ownership percentage at that initial purchase can never change. So think about, I'll use a simple example. Let's say that you personally are putting in 60% of the money for the investment and your retirement account is putting in 40%. You are a disqualified person to your retirement account. Initially, you are co-purchasing at the inception of the transaction. That is permitted. But from there on out, that 60%, 40% ownership percentage can never change as if there's a disqualified person. So that means all property expenses have to be paid by both parties in their ownership percentage. So if you got a bill for a new roof that was $3,000, in that example, you personally would have to pay 60% of that $3,000, and your retirement account would pay 40% of that $3,000 bill. Same with the revenues coming in. Let's say you got $1,000 rental income in a month. You personally would get $600, 60% of that would go to you personally, and $400 would go to your retirement account. That $600 would be included in your taxable income. The $400 goes to your retirement account and is tax deferred. So you want to keep that in mind, and that goes with any kind of partnership. The partnership percentage, the ownership percentages determine how expenses are paid and how revenues are distributed. Some clients do like to set up subsidiary LLCs within their IRA LLC to own a particular property, and you can do that, but doing that does not eliminate any of the rules related to the retirement account. All the rules still apply to that sub LLC as well. All the rules still have to be followed. Disqualified parties only at the inception of the transaction, ownership percentages can't change, that kind of thing. Now, I do want to mention something here because I'm asked this question a lot. If you do set up a sub LLC like this to own a property, and some people do this because they have multiple parties, what we will need to see at STC is an operating agreement that clearly states who the owners of this sub LLC are, and the amount that they're contributing and the percentage of their ownership of this LLC. And we would expect that the percentages of ownership would match with the amounts invested. So let's say it's a $200,000 investment. One person invests $100,000 and two others each invest $50,000. That first individual should be a 50% owner, and the other two should be 25% owners. Now, that's actually a requirement if the owners, any of those owners, are disqualified persons to each other. However, there is an exception that I want to mention here because some people do this. If one of the parties, if all of the people, none of them are disqualified persons, so you're all unrelated people in this sub LLC, and if one of the parties is going to serve another role, let's say, for example, is going to be the general contractor, they're not a disqualified party, then they can get a larger percentage of the profits for that role that they play. That can only happen, though, if none of the parties are disqualified persons. So if you have any questions about that, we will go over that in detail with you. But I want to bring it up since we're focusing on real estate as an investment here. And I do see a lot of real estate investors who do partner with other investors to own properties. So just keep in mind that all the rules still have to be followed. And disqualified persons can never do any rehab or repairs They can't be the tenant, they can't be the buyer or the seller. So let me just elaborate on that. Let's say you have, you've purchased a property and you have a son that, has a maintenance business or a repair business. Your son is a disqualified person to your retirement account. So your son cannot go and do any repairs on that. Now, your brothers and your sisters, your aunts and your uncles, they are not disqualified. So your sister could go do repairs on it. So you just want to keep in mind that you do have to be looking at those kinds of things when you are doing a real estate transaction. I'm also often asked, well, I'm a realtor. I'm a licensed real estate agent. So I would like to, do the transaction in my retirement account. We strongly encourage you not to be involved as a realtor with any transaction that involves your IRA. Because again, you are a disqualified person. You certainly could not take a commission for, a sale to your IRA. You can't receive any kind of compensation. So you want to be very cautious about that. So we just discourage it if you are a licensed real estate agent to do any kind of transaction on behalf of your retirement account. I do want to talk more about partnering with others because, as I mentioned, oftentimes I have met many investors who do this, and you can partner your retirement account monies with your own personal money, your spouse's retirement account, your spouse's personal money, family members. Now, I told you that most of these are disqualified persons. But again, if you do this partnership at the inception of the transaction, then it is not a disqualified, prohibited transaction. Colleagues, investing colleagues, you can partner with other LLCs, investment syndications. So all of these are possibilities for other co-funding sources with your retirement account. So let's look at this schematic, and you'll see same top part, but here we have three investments. One is in a tax lien. The second, you purchased the property that you have and now you're renting it. And the third investment, you actually are one of four co-owners. You co-invested at the inception of the purchase transaction. You, with your father, your daughter, and some of your personal funds, and your retirement account, you pooled these funds with others to purchase a small retail center. And now each of you owns a portion of that relative to the amount that you invested, and you will earn based on your pro rata ownership. So just to give you an idea of different things that you can do. This is an example of some investors. It's actually 10 people and 10 retirement accounts pooled money to purchase an apartment building. The price was $2 million, and they were going to pay 100% cash, $200,000 each from 10 people. I've rounded the numbers to make this easy to explain. So $100,000 from each of the people and $100,000 from each of their retirement accounts. What they did is they formed a new LLC, a business LLC, with 20 members that purchased that apartment building. So the members were 10 people and 10 retirement accounts. Each member owned 5% of that LLC. The rents were paid to that business LLC, and the expenses were paid by that LLC, and then the net was distributed to the member owners. So that's just an example to show you how you could pool monies with other investors and do a larger investment that you might not be able to do on your own. So now we're going to open the floor for your questions. And I did get a few in advance, and I will open my box. Please do I'll see if anybody has already typed any questions. If you haven't and you have some questions, please do that now. Click next to the word questions, and a box will open up, and you can type in that for me. And I'm going to open that right now so I can see it. Okay. Okay, so I did get a few questions in advance, and this one I have already answered, but I will answer it again. Can I get a mortgage on a property for my IRA account? And yes, of course you can, but it must be a non-recourse loan. And again, that means the lender only has recourse to the property the loan is on if there's a default. Okay, this is about contributions. Can you make the maximum contribution to both a regular and a Roth IRA in the same year? No, you cannot. That contribution maximum, $5,500 or $6,500, that is for IRAs, traditional and Roth in aggregate. So if you have one of each type of account, you can make contributions to both, but the cumulative amount cannot be more than what you are permitted in a single year, $5,500 or $6,500. Can you give me some ideas for possible investments for smaller accounts? Sure. Tax liens, we have a number of clients who do tax lien investments, and those are a much smaller amount, and they often earn very nice rates of return. And I do talk about those I have talked about those in a previously recorded webinar, so you can also look for that. Tax liens, private notes, you can lend from your self-directed retirement account to someone else and set the terms of that note. You can require collateral for that note. And of course, you can partner with others, like I showed you in the example, partner with others to co-own an asset that you perhaps couldn't fund fully from your own retirement account. Okay, can I purchase a property with funds in my retirement account and then sell that property and hold the mortgage for the new buyer in my account? Yes, you can, as long as that buyer is not a disqualified person. You sure can. Okay, and this one I did answer already, but can my retirement account purchase additional interest in a property I'm already invested in? And the answer would be no, because if you are personally already invested in it, your retirement account can't participate in that, because that would violate that disqualified person rule. Okay. Can I use funds from my retirement account to purchase a franchise? Possibly. You would have to actually check with the franchisor. It depends on them. It does, and if they do permit it, your investment would have to be a passive investment, meaning you can't run the franchise. You can't make, you would be a passive investor in that. Otherwise, you would be violating that disqualified person rule again. Okay, now this person is asking a question about money's converted to a Roth account. So I will give a general answer. How are taxes calculated on assets that are converted to a Roth account? So evidently what they have assets held in a traditional or some other kind of account. They want to move them into a Roth account. Remember, I said that contributions to Roth accounts are post-tax. You have to pay taxes on them. So if you are converting assets into a Roth account, you have to pay taxes on that. So if they are non-cash assets, then you would look at the market value of the account assets as of the date of the conversion, and then your ordinary income tax rate would apply to that value, that market value. I have money in my account that is idle from time to time for long but indefinite periods. I would like to earn a return by buying short-term instruments that will earn more than the bank interest. What options do I have? Well, you certainly can do a brokerage account, as I mentioned. You can open a brokerage account with any firm that you like. Then the account does need to be in the name of your IRA LLC, the account name that you set up with us. And then we would ask that you send us the monthly statements from that account so that we can see that you aren't adding any money to it personally. It would actually be owned by your IRA account, and then you can do the transactions within that account on behalf of your IRA. So you could buy stocks or bonds or mutual funds, and then when you found an investment that you wanted to invest in, you could liquidate whatever you needed to, and that cash would go into your IRA LLC account, and then you could purchase a different investment. So that would be something you could do with the money that was idle. Okay, another Roth account question. I have both a Roth account and a former employer 401k plan. Can they be combined in the same LLC? No, actually they cannot. The IRS does not permit that because they are two different kinds of money. Again, Roth monies are contributions and monies are post-tax, whereas 401k, traditional IRA monies are pre-tax. So you cannot combine those into a single account. Okay, do we have to pay fees for the help and advice? If so, can we get a list of fees? Oh yes, absolutely. Yeah, we do charge fees. That's how we stay in business. So we do have an initial setup fee, and then we do have an ongoing management fee. I can see who asked this question, so I will be happy to send you a copy of that, so a schedule of our client fees. We do have an initial setup fee, and then our ongoing management fee is less than 1% per year. It's 0.245% per quarter, and we do cap our fees. So once your account value is around $400,000, your fees do not go up. They stay the same. So, but I will send you, so you have a hard copy of the fee sheet. Okay, let me look at the time. I do have time for a few more questions. What is the time frame to get my account up and running with SEC? Typically, it takes anywhere from 4 to 6 weeks from the time that we receive the original paperwork. In that time frame, we are setting up an LLC in the state of your choice. We are coordinating the transfer of your monies from your current custodian to our custodian, and then setting up the bank account and the money from the custodian to the bank. So we are doing all of those pieces. The time can be a lot less than that. There are some things that we can't control, like your current custodian and the speed with which they release the funds. But we do try to expedite everything that we can control. So what I would recommend is if you know that you want the self-directed account and you're starting to look at investments, I would say you probably want to get your account set up started so that we're for sure ready, so that when you're ready to invest, you can do it. Once your account setup is complete, then you have that same day or next business day investing. So then it'll be a 24-hour turnaround or less. But we do have some initial work to do and to get the account set up initially. Can I open an IRA account if I'm over 60, and what is the minimum initial deposit? You can if you are over 60. There are some guidelines that the IRS has set. They can be found in IRS publication 590. You can just Google that and it'll take you right to their website. Basically, you, or if you file a joint return, your spouse must have received taxable compensation during the year, and you were not aged 70 and a half by the end of the year. Then you can open an account. And the account, to open an account, you can either transfer money from a current account, or a minimum to, with our company is $250 to open an account. Okay. If you have a rental property in your account, who does the renter send their rent check to? That really depends on if you're using a property manager or not. We do recommend using a property manager that makes sure that you don't get involved in ways that you shouldn't with your property, but you're not required to. Typically, when a property manager collects the rent, the checks are made payable to them, and then they forward to your IRA the excess funds. So they'll take their fee out. If you're not using a property, and then they would be sending that check to STC, written payable to your retirement account, and we would deposit that into your account. If you're not using a property manager, then the checks would be made payable again to your retirement account, your IRA LLC name, and mailed to our office. They could mail it to you, but then you'd have to mail it to us. So it's just simpler for them to mail it directly to us. In either scenario, you will receive an email when we have the funds, when the funds have been received and posted to your account, deposited. Okay, one last question before I tell you about our next webinar. Do I have a choice which state should, oh yes, do I have a choice where to set the LLC up? Yes, you do. Some states have different LLC fees. So what you can do is we will actually talk with you about that when you're completing the client paperwork, and our operations department can talk with you, and you can tell them what you're thinking, and we can give you some options so you can decide what would be best for you and your account. So yes, you do get to choose that. It can be in any state. We do have clients in all states, and I will just mention this, we can do investments throughout the country, wherever our clients are. And our clients can, some of them also do overseas investments too, so they don't necessarily have to be U.S. investments. I am going to need to close out this webinar. If you have additional questions that come to mind, please do feel free to get in touch with me. Let me just put this back and turn my slide on so you can see our website address is stcira.com. Our corporate office number is there on your screen. My email address is jknight@stcira.com, and my phone is listed there, 703-307-9116. So please do feel free to get in touch with us, and we would be happy to help you get started with a new account or answer any questions that you may have. I do monthly educational webinars, and our next webinar will be in September, and the date for that will be September 5th. And I will be talking in detail. I will be sharing some general information as well, but I will be talking in detail. If you are deciding what company you want to work with for your self-directed account, I'm going to be going through some different questions that you can ask different companies and get those answers to help you kind of discern what your needs are and what company would best work for you. So I'll give you a list of questions. I'll tell you how STC answers them, and then you could go and do some due diligence. So that will be how to choose your self-direction partner. I hope you will join us. You can sign up on our website, or you can, if you got an email invitation to this one, you will get an email invitation to that one as well. Thank you so much for joining me this evening. Good night.